If you're self-employed and the word Schedule C immediately make your stomach tighten, you're not alone. For some reason, this one form has picked up a reputation it doesn't deserve. People hear self-employed, Schedule C, business income, and their brain jumps straight to audit, trouble, extra scrutiny. But here's the truth most people never hear. Schedule C is not dangerous. Confusion is. Millions of people file Schedule C every year. Freelancers, Etsy sellers, tradespeople, side hustlers, one-person businesses doing honest work and reporting it the way the system was designed. Schedule C is not a red flag. It's not a confession, and it's not an invitation for the IRS to come knocking. It's simply a way to tell the story of your business, what came in, what went out, and what was left. Today's episode is about taking the fear out of self-employment taxes. We're going to break down what actually counts as income, what legitimately counts as a deduction, why overcomplicating your books makes compliance harder, not safer, and how Schedule C looks from the IRS side, without scare tactics or myths. This isn't about squeezing every dollar. It's not about hacks, and it's definitely not about gaming the system. It's about clarity. Because when Schedule C is simple, tax season gets a whole lot calmer. Let's start with what Schedule C really is, and just as importantly, what it isn't. At its core, Schedule C is one thing, a summary of business activity. That's it. It's not an investigation, it's not a test, and it's not asking you to justify your existence as a business owner. Schedule C exists because the tax system needs a place to report income and expenses when you don't receive a paycheck from an employer. That's all it's doing. What Schedule C is. Schedule C is designed to answer three basic questions. How much money did the business bring in? What did it cost to run the business? What was left after expenses? It doesn't care whether you work full-time or part-time. Your business is online or in person. You made a lot of money or a little. You've been in business for 10 years or 10 days. It's a reporting tool, not judgment. What Schedule C is not. Let's clear up some misconceptions that cause a lot of unnecessary fear. Schedule C is not an automatic audit trigger, a sign you're on a list, a form that only risky businesses file, a requirement to be perfect. Filing a Schedule C does not mean you'll be looked at more closely, you're expected to know tax law, you're doing something suspicious. It means you earn income outside of a traditional paycheck. That's it. And Schedule C feels intimidating because it has more lines than a W-2. It asks you to categorize expenses. It involves judgment instead of checkboxes, and people hear horror stories without context. Judgment doesn't mean danger, it means flexibility. And flexibility is necessary when businesses don't all look the same. From inside the system, Schedule C isn't rare. It isn't exotic, and it isn't alarming. It's expected. The IRS knows businesses fluctuate. Income isn't always consistent. Expenses vary by industry, and not every year looks the same. What matters isn't whether you have a Schedule C. What matters is whether your Schedule C makes sense as a whole. Think of Schedule C like a summary page. It should tell a story that's understandable, reasonable, and consistent with what you do. It doesn't need to be impressive. It doesn't need to be optimized. It just needs to be coherent. When the story makes sense, everything else gets easier. Here's what I want you to carry forward. Schedule C is normal. Self-employment is not suspicious. Complexity is optional. Clarity is powerful. In the next section, we're going to talk about the piece that trips people up the most. Income. What counts, what doesn't, and why under and overthinking income causes more problems than it solves. Let's talk about income next. If there's one area of Schedule C that causes the most anxiety, it's income. People worry about reporting too much, reporting too little, missing something, or reporting something twice. And that worry usually leads to one of two mistakes, either underreporting out of fear or overcomplicating income until nothing feels right. So let's simplify this. For Schedule C purposes, income is what your business earned during the year, not what you kept, not what showed up on one form, not what felt like profit, what came in before expenses. That's your starting point. Gross receipts versus net income. This distinction matters more than most people realize. Gross receipts is the total money received by the business. Net income is what's left after expenses. Schedule C starts with gross receipts. Expenses come later. A very common mistake is reporting net income as if it were gross, especially when people only look at deposits or platform payouts. That usually leads to underreported income, numbers that don't reconcile, and stress when forms don't match. Starting with gross keeps everything clean. Income is not defined by forms. This is critical. Your income does not equal the total of your 1099 NECs, the amount on a 1099K, or the number of platform reports. Forms are supporting documents, not definitions of income. You can have income without a form. You can have a form that doesn't perfectly match income. Both situations are normal. What matters is that all income is reported once, accurately, and consistently. If you earn money through online platforms, apps, marketplaces, cash or check payments, or side gigs that don't issue forms, that income still counts. Not because the IRS is watching, but because Schedule C is designed to capture business activity, not just paperwork. Again, this isn't about perfection, it's about completeness. Another place people get tripped up is when income isn't clean. Refunds happen, chargebacks happen, fees get taken out, payments reverse. That doesn't mean income disappears. It means income needs to be reported reasonably with adjustments reflected correctly. This is another reason why starting with gross activity and then accounting for reductions creates clarity instead of confusion. Let's name a few things that cause unnecessary problems. Only reporting what hits your bank account, ignoring income because it was small, assuming income doesn't count if there's no form, double counting income because multiple forms exist, or letting fear dictate what gets reported. None of those improve compliance. They just increase stress. From an IRS perspective, income reporting doesn't need to be fancy. It needs to be reasonable, consistent, and supported by records. They're not expecting perfection, complex allocations, or obsessive reconciliation in January. They're expecting a coherent story that matches reality. Here's the mindset that simplifies everything. Income is what the business earned. Form support, they don't define. Gross first, expenses later. Complete beats clever. Once income is handled calmly and clearly, Schedule C stops feeling dangerous. Next, we're going to talk about the other side of the equation, deductions. What legitimately counts, what doesn't, and why stretching deductions creates more risk than relief. Let's talk about deductions next. Once income is clear, deductions are where people tend to either freeze up or get a little too creative. And both reactions come from the same place, uncertainty. So let's remove the mystery. For an expense to be deductible on Schedule C, it must be both ordinary, common and accepted in your type of business, and necessary, helpful and appropriate for running that business. Those words don't mean required by law, used exclusively every day, or something every business spends money on. They mean the expense makes sense in context. Instead of asking, can I deduct this? A better question is, what business purpose did this expense serve? If you can answer that clearly and honestly, you're usually on solid ground. If the explanation starts to feel awkward or defensive, that's a signal, not a judgment, that the expense may be personal, not business. Most Schedule C deductions are boring, and that's a good thing. Common examples include supplies used in the business, advertising and marketing, platform and processing fees, professional services, software subscriptions, mileage or vehicle expenses related to business activity. These are the kinds of expenses the IRS expects to see. Nothing flashy, nothing clever. Home office deductions cause a lot of unnecessary anxiety. At a high level, a home office must be used regularly and exclusively for business. It must be your principal place of business or used to meet clients or conduct administrative work. If that doesn't apply, that's okay. If it does, it should be handled carefully and conservatively. This is one area where forcing a deduction does more harm than good. This is where people often get tripped up. Expenses are not deductible simply because you paid for them. They help you feel more professional. They're related to your lifestyle, or they have some vague business connection. Personal expenses with business vibes are still personal. If something would exist in your life even if the business didn't, it's probably not a business deduction or only partially deductible. Here's where insider perspective matters. Most Schedule C issues don't come from missing deductions. They come from overreaching, claiming too much personal expense as business, categories that don't match the activity, or deductions that don't align with income. That's what creates questions, not reasonable, boring expenses. The IRS does not expect you to maximize deductions. They expect you to report them reasonably. A Schedule C that shows income that makes sense, expenses that match the business, and a profit or loss that's explainable is far less concerning than the one that looks overly optimized. Here's what simplifies deductions immediately. Business purpose matters more than labels. Ordinary and necessary is about context. Personal expenses don't become business expenses, and conservative beats aggressive. In the next section, we're going to talk about something that quietly causes more Schedule C problems than almost anything else: overcomplicating the process. Why more tracking, more categories, and more optimization actually makes compliance harder, not safer. Let's talk about that next. Most Schedule C problems don't come from people trying to cheat. They come from people trying to be perfect. And perfection is where compliance quietly breaks down. A lot of self-employed taxpayers believe that the more detailed their system is, the safer they are. So they create dozens of expense categories, track every tiny transaction obsessively, split expenses into microscopic percentages, and use tools that they don't fully understand. It feels responsible, it feels thorough, but in practice, it often creates inconsistencies, misclassifications, errors that compound over time, or records that are hard to explain. Complexity doesn't protect you, clarity does. The IRS doesn't care whether you used office supplies, administrative supplies, operational supplies, or miscellaneous business tools. They care that expenses make sense for the business, totals are reasonable, categories are applied consistently. When categories multiply, decisions become subjective. Similar expenses get treated differently, and year-over-year comparisons break down. A smaller, consistent set of categories almost always produces cleaner results. Tracking everything can feel productive, but it often leads to burnout. People track every coffee, every small tool, every minor purchase. Then they fall behind. Then they stop altogether. Then they scramble at tax time. That's not a failure of discipline, it's a failure of system design. A system that requires constant vigilance is not sustainable. Software can be helpful, but it's not a substitute for understanding. When people rely on software without clarity, categories get misused, rules get misunderstood, and reports don't reflect reality. The IRS doesn't care what software you use, they care whether the information is reasonable and supported. Simple tools used consistently outperform advanced tools used incorrectly. When people chase every possible deduction, the return becomes harder to explain. The numbers stop telling a clear story, and small errors become big questions. From an IRS perspective, a Schedule C that looks aggressively optimized often raises more questions than one that looks conservative and coherent. Clean beats clever every time. The goal isn't to track everything. The goal is to track enough. Enough to support income, support deductions, explain changes, and answer questions calmly. That's what compliance actually looks like. Here's the mindset shift that simplifies everything. Simple systems are easier to maintain, consistency beats detail, clean records beat clever strategies, and sustainable habits beat short-term optimization. In the next section, we're going to talk about Schedule C through an IRS lens. What actually gets attention, what doesn't, and why most self-employed taxpayers are far less risky than they think. Let's talk about that next. This is the part most self-employed people want to know, and fear the most. So let's talk about it plainly. From an IRS perspective, Schedule C returns are not suspicious by default. They are common, expected, routine. What gets attention isn't self-employment, it's lack of clarity. When a Schedule C gets looked at more closely, it's usually because the numbers don't tell a clear story together. Examples include income mismatches, income reported on Schedule C that doesn't align with third-party information or prior year patterns, expenses that don't match the business activity, categories or amounts that don't make sense for the type of work being done, repeated losses without explanation. A loss one year is normal. Losses year after year with no narrative or change raise questions. And big swings with no context. Income drops sharply while expenses increase, or vice versa, without a reasonable explanation. Notice what all of these have in common. They're about patterns, not single decisions. This part matters just as much. A Schedule C does not automatically get attention because you're self-employed, you claim deductions, you had a loss one year, you had a profit, you're small, you're new, you're online, you're cash-based. Those are all normal business characteristics. The IRS understands that businesses fluctuate, income isn't linear, expenses change, and growth is uneven. Normal business behavior is not risky behavior. From an insider perspective, the Schedule C returns that cause the least concern are often the least flashy. They show reasonable income, reasonable expenses, categories that match the activity, and numbers that align year over year. Even if the business is small, the profit isn't huge, or the system isn't fancy. Clarity makes questions unnecessary. Aggressive returns are fragile. They rely on maximum deductions, tight interpretations, and perfect documentation. When something changes or when a question is asked, those returns are harder to support calmly. Conservative, coherent returns are easier to explain, easier to defend, and easier to live with. Here's the insider truth. The IRS isn't looking for perfect Schedule C returns. They're looking for the ones that make sense. If your numbers tell a clear, reasonable story, most scrutiny never starts. Let's bring this back to something actionable. A calm Schedule C is built on a few simple habits, not complicated strategies. The approach that works looks like this: track income consistently, categorize expenses reasonably, separate business and personal activity, keep basic documentation, and review regularly, not just at tax time. That's it. Not perfection, not optimization, not constant adjustment, just steady, understandable records. A system you can maintain beats a system that looks impressive but collapses under pressure. If your bookkeeping system makes you dread opening it, requires constant correction, or feels fragile, it's too complicated. Schedule C works best when the system behind it is boring and repeatable. Self-employment doesn't have to be stressful. Schedule C doesn't have to feel risky. Compliance doesn't have to be overwhelming. Stress usually comes from overthinking, overtracking, or over-optimizing. Simplicity creates confidence. Let's close with this. Schedule C is not something to fear, it's something to understand. When you know what counts as income, what counts as a deduction, why simple systems work better, and what the IRS actually looks for, self-employment stops feeling dangerous and starts feeling manageable. If this episode helped you feel more grounded about Schedule C, I encourage you to subscribe to the podcast, share this episode with a self-employed friend who's stressing, and come back for the next episode, where we'll continue breaking down IRS processes in plain English. Tax season doesn't have to be chaotic, and self-employment doesn't have to come with constant stress. Thanks for listening, and we'll talk again soon.